Alrighty. Thanks for joining me, everyone. Today we're over at Grand Canyon University, and we're joined by a very special guest today. We have Joe Hegener. Thanks for being here today, Joe.
Thanks for having me.
And today we're talking a little bit about what we have going on at GCU. Over the last few weeks, we've been embarking on this incredible journey to be a part of this faith-based fixed income ETF. And Joe, over at FTHB Capital, serving as the Chief Investment Officer, has been helping us along the way. So today we're bringing him in, talking a little bit about himself, what they have going on over at FTHB, and learning a little bit more about how faith and investment can go along side by side. So appreciate for being here today. What do you think of GCU so far?
Oh gosh, I've been kind of floored, honestly, with GCU and the students in particular. Just strike me for your guys' age, the entrepreneurial spirit that exists here in this institution, and the professionalism from 18, 19, and 20-year-olds. I've been blown away by. So it's been a great experience. I really like coming down here. I get to hang out with you guys and the other students, and hopefully add some value and teach you guys a couple of things. And then it's exciting to see you all kind of get sent off into the ecosystem armed with skills and experiences that hopefully are differentiating.
Yeah, exactly. I've been fortunate enough to serve as a student part of this whole FTHB project, but do you want to provide just a little bit of context exactly, what is the collaboration going on between GCU, FTHB, Faith Investor Services, and what we're kind of building here?
Absolutely, sure. So there's an entire ecosystem around faith-based or faith-driven investing, making sure that individuals, retirement accounts, investment accounts are aligned with shared values, effectively faith-based and biblically aligned principles. And there are a handful of investment products that exist today. Most of those are in like the equity or the stock filtration space as it relates to faith-aligned investment vehicles in exchange-traded funds like an ETF. That's what FTHB is. But kind of interestingly, there really hasn't been much innovation in the space that's biblically aligned with regards to fixed income. And so that's some of the feedback that we received from some of our kind of faith-based institutional investors over the last couple of years. And so that's really what we're trying to solve here with FTHB. And we can talk about the strategy and all those types of questions on a going forward basis. But really, the idea is to set up a vehicle that is going to be sub-advised by us. So technically, FTHB Capital would be the portfolio manager and making some of the investment decisions within the context of the fund. The advisor, the sponsoring advisor, is Steve Nelson's group, FIS, Faith Investor Services, and they really own and run the product itself. And without them, this wouldn't be a thing. So kudos to Steve and his group. They're doing amazing things. And then, of course, Grand Canyon, right? And that's the kind of the critical piece where this becomes really interesting, where there's a research kind of collaboration and a partnership with the university. We work with the finance students, the theology students, the marketing students, and effectively, this is a real living, breathing project, an entrepreneurial project with the idea of growing and scaling it, having it become a successful venture. And then any, the management fees that are inevitably generated from this, we're going to be donating a big portion of that back to donor-advised funds that in turn reinvest in Christian higher education. Hopefully GCU is a big benefactor of that type of a donor-advised fund. So it's a great idea. The idea is to kind of create this positive flywheel where we're investing in the students. The students are getting great experience. They're contributing to the success of the venture. The venture kicks off great economics for Christian higher education more broadly. And the students can go off into the ecosystem and go join whatever firm they want to join. And they have, biblically aligned moral compass. They have hands-on real-world experience on how to manage portfolios, even marketing, account management, things along those lines.
Totally. Yeah, it sounds like it's a great collaborative experience, for the students, to collaborate with you guys, as well as Grand Canyon University and getting, the investments out there and getting that, philanthropic side out there as well. Looking into, the bond world, right? It's seen as the risk-off version of investing. And when looking into that, you've had tremendous experience in that space, and we can dive into that a little bit later today.
Sure.
But I just kind of want to start off, asking, when did you first realize that you saw risk differently from other people, being in this space, having this profession, It's pretty unique.
It's an interesting question. I think everybody kind of has their own view, their own personal risk tolerances and limits, and just in full candor, I think when I was younger, I was a little bit more aggressive. I had a very high tolerance for risk, and whether that be personal investment risk or career risk, for example, even academic, reaching and taking classes that might have, go either way. And then also as it relates to investment management, as a portfolio manager, especially when you're managing money on behalf of other people, that's a whole different risk paradigm to talk about. And so just over the last 15 years of professional experience, you sort of build up, frankly, through a little bit of trial and error, what the appropriate level of risk taking is, how to size positions appropriately, how do risks interact with one another from a correlation standpoint and a covariance standpoint. And so, I'm really grateful for some of my early experience when I graduated from college, because I started in the risk solutions group at BlackRock, and it's all quantitative and risk modeling, which was really helpful in the context of portfolio construction on a going forward basis.
Yeah, totally. Looking at kind of that experience in BlackRock, I want to dive into that a little bit more. You were structuring different trades against, different pensions funds as well as CIOs and CROs. And, looking at that, I'm curious to see, what was your most single misconception or your biggest misconception being there?
Oh, gosh. The biggest misconception. So the group that I worked on, we were kind of like outsourced analytics, reporting, and some advisory function for institutions, insurance companies, pension funds, some central banks, some really large corporate balance sheets, for example. And I would say, this is kind of a hot take, but
We're here for it.
I would say that the biggest misconception is that a lot of chief risk officers in particular, they take the analytics as gospel, as the truth, right? And in my mind, a risk report or a single analytic, something like value at risk or standard deviation, or there's 1,000 different ways of measuring different risk parameters. And it's important that you understand how they work, because it helps you think about kind of modeling the world around you. But the world doesn't fit into like a perfect little bell curve, right? And so there are inherent limitations around what a single statistic might tell you. And I would say that there are a lot of, especially on the institutional kind of more bureaucratic side of things, there were a lot of chief risk officers who kind of came in and they would ask us, okay, so you took a look at our whole portfolio, every single position, you've done all this analysis, so what's my risk? What's my portfolio risk? And we'd kind of laugh and be like, well, what do you want it to be? Because I could easily create a very viable report with a certain set of assumptions that says your value at risk is 8% annually. I could just as easily make it 3. I could make it 15. It just depends completely on the assumptions that you're making.
Right.
Covariance, matrices, all sorts of things, half-lives. And so all that's to kind of say it's important that you know how it works, but if you put too much weight into what the output is, you're kind of missing the point altogether, right? It's really just a helpful framework for understanding what you're doing at the end of the day. And there's still a lot of it is an art, in my opinion.
Yeah, kind of diving into that art a little bit. A lot of the time, right, you can boil it down to just the numbers, but then I feel like there's also that intuition aspect as well, in terms of learning at, what is actually behind a company, what's moving it, and how do you weight those different kind of assets together in terms of, right, intuition versus just looking at just the numbers themselves.
Oh boy. You're right. There's like an art component to it for sure. And especially, in recent days, like particularly within the stock market, bond market's completely different. It's still very inefficient relative to the stock market, right? Stock market has been somewhat commoditized, and high frequency trading and algorithmic programs have been very pervasive across the space, especially over the last 20 years or so. So that really has changed the way that everything works within the stock market honestly. But at the end of the day, I mean, you're right. There is still an intangible component as it relates to who's running these companies, what the zeitgeist is around kind of hype and investment flows, right? If there's a lot of excitement around AI, for example, and investors are very excited about what the future might bring, they might forget the fact that, this valuation is a little ridiculous from a historical lens, and they might invest in that anyway. And those types of trends can exist for a very long period of time. And so, I mean, to your point about just going by the numbers, that's something that a lot of value investors really struggle with, right? Is because, they're looking at, like, for example, like the AI bubble or whatever you want to call it, and they're clearly pounding the table. Yeah, we're in a bubble, and they're probably right. But if you fast forward, or if you rewind 20 years, the dot-com bubble, right? If you were a professional investor and you were just looking at the company valuations and the numbers exclusively, and you were pounding the table in 1995, saying that the internet, the dot-com era was in a bubble, you were right. It was a bubble. But you also missed out on 4 or 5 years of 40% equity market returns until you inevitably were right and the bubble burst.
Yeah.
So there's a whole other component to this around not necessarily hype, but flows, where investment dollars are going, liquidity profiles across asset classes, should also be taken into account.
Totally. One of the best quotes that I love to really share with people is the one from Mark Twain, where he says, "It's not what you don't know that gets you in trouble, but it's just what you know for sure that just ain't so." And I think that is so true, especially in the markets today, where you have a lot of concerns around private credit, a lot of concerns around AI, and a lot of concerns about the wars that are happening around the world. Kind of looking at those situations, there's a lot of nuance in that. Mm-hmm. And having your experience not only at BlackRock but also at PIMCO, looking at kind of the size of deals and looking at how do you go and structure different investment decisions based off that. I'm curious to see, over at PIMCO, you had experience working on billion-dollar books, right? And as well as million-dollar books as well. Sure. What is the main differentiator, if any, that kind of separates between the two?
In terms of managing size, so the desk that I got to work on when I was kind of a junior guy there is about 125 billion across a bunch of different accounts. And I think the smallest account was $8 million, and the largest account was like 16 billion or something like that. And I'd say the biggest difference between managing an account of scale in a smaller account is it's much easier to make money consistently and have an edge in a smaller account. Because when you have that kind of a scale, if you have a $5 to $10 billion portfolio, you're not turning over all those positions very quickly. Like, for example, if I, spent time buying $10 billion worth of bonds in this portfolio, and Donald Trump tweets something about the Iran war or whatever, and we make the decision, holy moly, we need to get out of energy, or maybe we need to get in energy, or whatever it might be. It's going to be almost impossible for me to meaningfully change the composition of a $10 billion portfolio very quickly. Right. I'm not going to be able to go and sell $10 billion worth of bonds and get a very good price. Whereas if it's a $5-10 million portfolio, I could sell the whole thing in 5 seconds, and I could reallocate and redeploy, so I can opportunistically kind of be a little bit more nimble about where my exposures are. The other example I'd give is when it's a bond portfolio of that size, you're constantly receiving cash via coupon payments and maturities, particularly if the bonds you're buying are shorter in duration. They mature in a year, 2 years, 3 years. So you're constantly getting this net income of cash every day, every week, and you need to reinvest that, right? And so, if you're a PIMCO or a BlackRock or a Neuberger, I mean, you're getting billions of dollars of cash every day, potentially, depending on your financing and everything. And you need to put that to work. So you're going out into the marketplace and you're buying several $1 billion worth of bonds every day. And the disadvantage to that really is that it's very hard to be super choosy about what you're buying if you're forced to be buying billions of dollars with bonds every day, right? So you kind of become, with scale, you kind of become more of like a catch-all, all-encompassing, very diversified index. And granted, there are lots of things you can do with derivative overlays, and these are really, really smart, sophisticated guys, and they consistently outperform these indices. But nonetheless, you still become the very big kind of bloated diversified fund. Whereas if you're small, it's just much, much easier, right? If I only need to deploy several $1,000,000 a week or something along those lines, I can be very selective about what I'm actually investing in, which I think is a big advantage.
I think that's huge. Yeah. Looking into that too, you've had tremendous experience, been surrounded by incredible people, not only at BlackRock, but also by PIMCO. And there's a version of PIMCO that you definitely learned and got taught from. But I'm curious to see, was there any side of that that you didn't absorb, that you purposely were maybe like refraining from in that?
I would say, the last thing I would ever want to do is talk poorly about any of the firms that I worked for. But I think it's also reasonable to say that there are some firms that have pretty defined kind of cultures, work cultures, and there's the Googles of the world, and there's the BlackRocks, and then there's the Salesforces, and everybody, the management team defines what the culture is going to look like, and so for some employees it's a great fit, and for some it's not. I have the utmost amount of respect, especially for the PIMCO guys. I mean, they grind, right? I mean, we're talking about successful people who have already done quite well for themselves, and they're back at it every day, day in, day out. They're up at 3 a.m, 4 a.m. They're on the floor, suit and tie. They're working very hard. The performance output out of those guys is amazing, and that's one of the reasons why they're the best, or one of the best. But with that type of a dynamic, there are also, I think, cultural elements that, for me at least, I'm a little bit more of an entrepreneurial type person, and it made sense for me to leave and try to strike out on my own and try to set up a firm with my own distinct culture, where hopefully I can borrow some of the qualities from my predecessor firms, and then instill a little bit of my own kind of take on how I think a business should be run. And I might be completely wrong in how I construct it, but so far so good. But when I first started out, when I was at BlackRock in New York, I worked on a project, and kind of outside my normal 9 to 5. I wanted to build something that I thought might add some value to a client. And I worked pretty hard on it. I spent a lot of time on it, and I built it all up, and it ended up kind of becoming a thing. There were resources dedicated to helping build it out. And I think at some point it became a revenue generator for the firm. And I'll never forget, I think my bonus at the end of the year after putting all that work in was like an extra $8,000 or something like that. Which, don't get me wrong, it's a lot of money, but it wasn't commensurate with the amount of work that I had put in and the revenue that the firm was making. And so that was kind of the moment for me where I just figured, well, if I'm going to be busting my butt, I want to own the upside, right?
Yep.
It's one thing to kind of go clock in and clock out, and maintain that kind of corporate path, which is fine. That's a great avenue. But you talked about the career risk, earlier on in this podcast or this conversation. I wanted to take more risk. I wanted to try to own some upside, and that's kind of how we ended up where we're at.
Yeah. I kind of want to dive into that a little bit deeper. I know we've had conversations of how AstraZoa kind of came to be, but kind of walk us through that journey from BlackRock to PIMCO to ultimately now being over at AstraZoa in Phoenix, Arizona.
Yeah, sure. So I was a couple years in at PIMCO, and I was married but didn't have any kids yet. And I figured, I'll take a shot. I'll take some career risk while I'm young. And if it doesn't work out, I'll just go get a job somewhere else. And that was kind of my mindset. And this was early 2019. And so I quit. And I think I had an idea of what I wanted to do, and I think I had something lined up. And about 5 days after my 2 weeks was up, found out my wife and I were pregnant with our first kid, which really changed the risk-taking paradigm quite a bit. But I already made the decision. 2 weeks was up, And I'm actually, in hindsight, super grateful that is the series of which I found out, or the series, right? Because if I had known that my wife was pregnant, I wouldn't have quit. I would have
Right.
stayed for the consistent paycheck, and the healthcare. And so, long story short, there was an RIA, great group of people. Um, they were based out of Detroit with a satellite office in Las Vegas, and they were willing to pay me a salary to be their CIO, while on the side, I worked on what I wanted to do, which was to develop a hedge fund strategy. And so I took my pregnant wife to Las Vegas, and I was running this RIA, launched that hedge fund January 2020, and ran that for a couple of years. It ended up going pretty well. 2020 and 2021, there was just a lot of volatility and some white knuckle driving there in the middle of the year. But nonetheless, I spun out of that completely. My wife was born and raised here in the Valley. We have a lot of kind of extended family here. I had a baby. It just made sense to kind of come down here, be close to family, go independent, set up shop. And that's really the kind of the genesis of how we have the firm today. So I still run and manage a hedge fund. We have a lot of other things we have going on too at the firm. And we also sub-advise 2 ETFs, of which FTHB is one.
Yeah. Sounds like it was a very, very eventful time during that season. So to say the least.
Yes.
Kind of on that as well, I'm curious to see, what kind of conversations that you were having at yourself, either with mentors working kind of in your early career or during that time, right, during 2019. What were some of those conversations you were having with mentors, or what advice you wish that you could give yourself back then?
That's a good question. I had good advice early on in the context, I think, of networking. I can't stress how important this is. I can't stress enough how important this is to find, wherever you end up living, working, wherever, find a few people that know the industry well, that you kind of look up to from a career standpoint, and just make a point of getting coffee with them once a month, once a quarter, just checking in, asking for advice, asking good questions. And so, when I was at BlackRock, there was a couple of different people that I would make a point of trying to go get coffee with them, or even people outside of the firm, right? That I would just meet through a friend or through a friend's mother or father or whatever, and just making sure that your intent is to go and be proactive and really expand your network, because at the end of the day, like, that's one of the most powerful assets you have in your career and your trajectory, is who you know, and does everybody like and respect you as a good, thoughtful, moral person, and can this person, kind of depend on this person to get the job done, and so that was very, very helpful throughout my career, just bouncing ideas off of these men and women who have 20 years more experience than I do navigating the industry. These guys have made mistakes. They've learned from those mistakes. Hopefully, they can tell me about it and I don't have to learn myself, right? So I would definitely stress that that's a major one. Make a point of finding some mentors, and it doesn't have to be super formal. Just go to coffee, go to lunch, thank them up and down for taking the time, and kind of go from there. And you'll be surprised to see how that kind of yields dividends over time. I was also fortunate too, from a young age. My father worked in the industry, when I was kind of growing up, and so I was already vaguely familiar with how not necessarily all the inner workings, but I had an idea of, buy side versus sell side, and what banking was versus asset management and things like that. So kind of high school, college area, I had a pretty good idea of, what I was trying to break into, which was helpful in the context of selecting classes, networking, extracurriculars, things like that.
Yeah, I think that's really good advice for any of our young listeners out there. So I think that's huge. Starting Astrozoa, I'm curious to see, during that time, what was something you underestimated most about starting it?
What I underestimated most was how difficult it would be to raise capital from potential or prospective investors. I had what I thought was a pretty good resume in terms of the different shops that I've had experience, and then one of the things, and just to that last point, that last question we were talking about, you know, a really good piece of advice that I received early on in my career also was try to define like where you want to be in 10 years and then work backwards and try to build a mosaic of experiences that would be really accommodative or lend itself to that outcome. And so I was very intentional about that. When I got to BlackRock, I wasn't super happy with the first group that I ended up working for. And that's fine. Like, it's no big deal. It wasn't the standard approach. But nonetheless, I learned a lot of things from that group. And I tried my best to move around from group to group and try to build this mosaic of experiences and knowledge that would at some point lend itself to being a portfolio manager at a hedge fund. And so, I went from risk solutions and a little bit of advisory work, and I could talk intelligently about asset allocation and kind of high level markets and portfolio construction, but I realized that I didn't have any direct trading or portfolio management experience, so I left. That's why I went to PIMCO. And so you just build this up kind of over time, and then at some point you say, okay, I think I've got it. I think I've got enough experience. I'm gonna take a shot. And so that's ultimately kind of what happened. So nonetheless, right, I had what I thought were all the checked boxes in terms of the checklist of things that I thought that I needed in order to raise capital and be a successful hedge fund. And gosh, I was just so naive. I was still a kid, and I was high 20s, low 30s, and couple years of running my own fund in that predecessor fund. And that predecessor fund, did have some very good performance and some good numbers I could point to. And I thought that would be enough. But honestly, it wasn't. Raising capital is so much more, particularly from institutions. You need real infrastructure. You need years worth of a track record. Lots of kind of supplementary data, large data rooms, just things that as a 1-man, 2-man, 3-man shop, it's very, very difficult to put together, right? And so that was a very big kind of long duration learning experience for us. Is it can't just be a flash in the pan type of a report in terms of what your performance was in 2020 or 2021, right? Institutional investors in particular are looking at a lot more than just the young kid who had a couple of years of good performance. And so sort of methodically over the last handful of years, we've been in business for, 4 or 5 years now. And over time, it's taken 4 or 5 years really to get to the place from an infrastructure standpoint, reporting, building the track record, all of that to really be kind of taken seriously in a more institutional or professional context.
Yeah.
So that was probably my biggest misconception going in, but it's a learning lesson. And that's the whole thing about being an entrepreneur, is like you throw stuff against the wall and you see what sticks, and if it doesn't work, you just keep going and you just keep learning, and hopefully you don't make too many mistakes along the way, and you just keep growing.
That's right. Yeah, it's that lifelong learning, and it's that journey. Being an entrepreneur and having that mindset is one of the hardest things you can do. Oftentimes I think it is reading into, what people do under pressure. What do you do under pressure? And kind of with that, is there any way to train for that? And if so, how?
Oh gosh. Any way to train? I'm not sure if there's any way to necessarily, maybe there is. I'm certainly like pretty far from like a therapist or a psychologist, but for me, like I've always kind of been an adrenaline junkie type of a person. Like I love skydiving, I like extreme sports, I like heli skiing. So for me, it was kind of the opposite, where I needed to learn how to clamp the brakes, right, in order to actually do this and not take too much risk. But I do think, to your point, it's being an entrepreneur in any business requires a significant degree of risk taking and a lot of confidence that you're going to be able to pull it off. And maybe even if you don't pull it off, having confidence that you'll still be okay, even if it doesn't work out. And so, it's to that end, I think just being as prepared as possible is a really big confidence booster. I coach high school. I was assistant coach at a high school boys lacrosse team. I played in college and in high school, and I get a kick out of getting back out there and kind of watching these high school kids figure out their lives and stuff. And that's kind of what I say all the time is when you're going into a game, the only way to really have the confidence walking onto the field that you have the chance to win is by knowing that you've done everything you could up until that moment to prepare. Because if you aren't prepared walking onto that field, there's going to be some doubt in the back of your mind. And honestly, if you did everything you possibly could and you end up losing, I don't think anybody cares. I mean, I certainly, as the coach, don't care. The kids shouldn't care either. They did everything they could. And as long as you do everything you could, then I don't think there's anything to be upset about. But the preparation thing, I think, is a big one for sure, because that'll keep you up at night too, right? If you know that there's something you should be doing and kind of putting it off, particularly like in entrepreneurial land, that can be like very stressful. So as long as you just are kind of methodical about making sure you're taking care of your responsibilities, work-life balance is also important, albeit very difficult when you're self-employed. So those things I would probably point to.
Yeah, definitely. Being a part of the lacrosse team at college, as well as now being a coach for a high school team, that sounds like a very busy, very fun opportunity to get into. What has that experience been like? What have you learned from that? And how has that kind of transformed into any career mindsets?
Interesting. It's a good question. The reason I coach now is because the sport really, really helped me out in my development as a kid. I wasn't really athletic, honestly, going into high school, and I went to a really, really big high school where unless you were like a superstar in something, it was just very easy to get lost. And I ended up finding this sport that I was pretty good at, and I invested a lot of time into it, and I had a lot of great mentors and coaches along the way who I really still keep in touch, to this day. And I ended up getting recruited to go play at a really good school, Ivy League school, and and that kind of changed my life, right? I mean, I wasn't planning on going to University of Pennsylvania or Dartmouth or Harvard or anything like that, and the sport kind of opened that door for me, and kind of opened up this possibility, and so I ended up going and taking classes at Wharton and meeting all these very interesting, very intelligent people, and that set me up with my career in New York, right? And so, if I think back to, what my life would have looked like, I could have been very different if I hadn't found that sport and gave it my all and really developed and became a good enough player to get recruited. And so that's kind of the reason why I coach now, is like I kind of feel obligated to give back to the game a little bit, and maybe like it makes a difference or moves the needle for somebody else.
Yeah.
And then, in terms of being a student athlete, I mean, I'm sure lots of people on campus are student athletes. There's some great programs here at GCU. I think it's really beneficial. It's really helpful in terms of time management and prioritization of responsibilities. You learn that, pretty young, and you're going to make mistakes, but you're going to learn from them. But that'll lend itself very nicely to kind of reality when you graduate and you have to, work a full-time job, eventually start a family. Like there's all these things that you need to prioritize, and the free time just doesn't really exist in the way that it otherwise would when you're a D1 student athlete.
Yeah. Life gets busier and crazier every year.
Yeah, 100%.
And then you just got to get more used to, how do you handle that? How do you navigate that? What's interesting about that, when what you said about going through, different opportunities that kind of present themselves and capitalizing on those. I mean, you look at some of the leaders today in the world, right? Like, Bill Gates or Elon Musk or whatnot. And you see, that, extremely talented individuals, extremely talented, extremely smart, extremely hardworking. But you see you backtrack all the way to, what moments throughout their life built their career. And you notice that a lot of them had these kind of people in place, like Bill Gates had an amazing professor at the time at a school that, didn't have, they had all the technology when other schools didn't. And then he kind of dove into that and he started learning more and more and more. And then he was fortunate enough to meet a couple of other people along the way, and he kind of was in the right place at the right time. And I think there's something kind of to be said about that, about all of our journeys on all of our paths, especially when it comes to a world of a lot of unknowns. And kind of within that, I'm curious to see, what is your best either advice or kind of take on going out and capitalizing on opportunities that present themselves, either in life or in the market, and how do you kind of discern on something that is an opportunity versus something that could be spent doing something else?
Yeah, it's a really good point and a really good question. I would say, because you're right, every person on average is probably going to be handed 3 or 4 opportunities in their lifetime that could be enormous. And so I think the thing to do is to kind of prepare for those moments. And the only way I know to do it is just by continuing to work on yourself and just the self-improvement. That way, when somebody does hand you the opportunity, you're in a position to actually take advantage of it. There's a Richard Branson quote that I really like is, if somebody hands you an opportunity to do some great opportunity to do something, just say yes and figure it out. Don't waste time thinking, oh, I don't know if it's the right fit, or I don't know if I can do it, or I don't know if I can pull it off. Because worst case scenario, you say yes, you take it on with a full heart, you try your best, and it doesn't work out. I don't think anybody's going to really fault you, at least anybody worth being friends with. And nobody's going to fault you if you really, really, truly did your best and it didn't work out. And you did it morally and ethically. And if it doesn't work out, it's going to be an unbelievable learning lesson. No question. Like, that's the worst case scenario.
Yeah.
Right? And best case scenario, obviously, you paint these pictures and, see like how entrepreneurs can do really well if they have the best case scenario. So I think that just getting yourself to be in a position to where you can actually capitalize and take advantage of those 2, 3, 4 opportunities that God's going to give you or set you up with, put you in the room with somebody. And that's why I think the networking thing is so important too, because via that networking, you're exponentially increasing the odds of getting handed another opportunity. So just continuing to work on yourself, whether it be literally psychologically, just making sure you're there from a mental health standpoint, all the way to education, to where you're investing in yourself, you have an idea of where you want to be, and you're backing into that through growth of some capacity, whether it's going to the gym or going to the library or maybe a combination of the two. You set your own goals. And as long as you just continue working and you really invest in the networking, you're going to be handed these opportunities over and over again.
Yeah. I think what one good piece of advice on that too is it's not what you know, it's not who you know, but it's who knows you. And I think that's a really, really powerful, complementary aspect and skill to have and build up as well. Kind of moving into that into that, seeing how those skills have transitioned into your investing world, seeing how they transition into what we have building here at GCU with FTHB, combining the faith and the investing side together to invest in companies that are making the world a better place. Can you break that down a little bit for us in terms of what exactly are we kind of investing into? Why are we investing into it? And what it really means to kind of be morally aligned in terms of a very confusing investing world today?
Sure. Yeah. So moral alignment, this is why this project is so interesting, applying it to the universe of fixed income, because it's a lot easier, honestly, to apply it to the equity landscape because they're all corporations, right? And they're managed by a specific executive team. And I mentioned every corporation has their own culture and their own standards and values. So it's a little bit easier to take a look at that. It's another thing altogether. It is to take a look at a securitized product, securitized product where the underlying collateral are, airplane leases or auto loans, prime auto, subprime auto. Is subprime auto considered usury? What does it mean for me to invest potentially in an Egyptian sovereign bond? Right. So there's lots of interesting questions that, we're working on in collaboration with the tool that GCU has developed and the theology students. And I find that part very fascinating. But at a very high level, right, the moral alignment, right, of course, we don't want to be investing in businesses that go against Christian values. That's pretty straightforward. In addition to that, right, like I mentioned, like subprime auto, like usury, for example, like there are also biblical principles that don't necessarily have to do anything with corporate values necessarily, but we still want to stay away from those asset classes. But then the kind of the more fun angle, or like the less less depressing angle, is not necessarily, well, we only want to invest. We don't want to invest. It's not the negative filtration process. It's the positive filtration process. What businesses are out there? What lending platforms are out there that are helping kind of change the world, investing in infrastructure in Africa, for example, for clean water, or a corporation that is actually doing really interesting things via, donations to Christian-aligned advised funds, donor-advised funds, or things like that. So we also want to be taking a look at the positive angle and trying to invest in those businesses, while still, of course, maintaining a comparable or an attractive risk-return profile in the overall fund.
Yeah. FTHB is targeting a very attractive return, against the aggregate. And I'm curious to see, with that faith aspect, is there any chance, or is there any, in your mind, does the faith filter cost you alpha, or is it more parallel to, a positive performance?
It's a good question. I really don't think the faith filter costs alpha, because how large the fixed income universe is. It is enormous. It's an orders of magnitude larger than the equity space, right? So the sandbox that we have to play in is just so much larger, whereby we can still invest in products that are faith aligned, and we don't necessarily have to do that at the direct cost of portfolio yield or kind of the risk profile of the overall fund. I think it'd be a lot harder to do if we were constrained to a specific equity sector, for example, right? If the only thing we were allowed to invest in was United States stocks that are tied to information technology, I think that'd be a very hard strategy to run on a faith-aligned basis without losing some element of alpha. But given the fact that our sandbox is so large via global fixed income, it does not move the needle necessarily in terms of sacrifice.
Yeah. Biblically responsible investing is one of the flavors of value-based capital. And I think the underlying question that a lot of these folks in the investing world ask themselves is, does the source of my return matter more morally? And I think, this is one question that they face. And, I'm curious to see what's your answer for the person who isn't faith-driven, but is asking themselves the same question.
Interesting. So, if I'm going to think about that question, are you asking if somebody is not a faith-based or not necessarily a believer, or how should they be viewing this product or the strategy?
Yeah, if they're not in the faith space, right? Maybe they're maybe they're not Christian, or
Sure.
maybe they're another religion, or just an atheist.
Yeah, it's a good question, because we do also have in our network, secular and institutional investors that, maybe they're Christian owned, but they're not necessarily in 100%, Christian clientele, for example. And so, I think that's a really interesting component, because there's an element where if you're just looking at the risk return profile of the fund, it's still as competitive as anything else on the market, right? And so one of the things I think we need to do, Grand Canyon as well as my firm, in terms of our outreach in the way that we message this product, is yes, this is still aligned from a values standpoint, but we're not sacrificing performance. We're not taking undue risks or anything along those lines in order to obtain or achieve that goal. Because I do think, admittedly, when a secular investor sees the biblically responsible, faith-aligned investment strategy, maybe in the back of their head, they're thinking, okay, well, how is this different? And we want to be proactive about that message. right? As opposed to them kind of making some kind of an assumption about what that strategy might look like.
Yeah.
So being proactive in saying, yes, like we are doing good. We are investing in higher education. We're investing in businesses and lending platforms that are in turn aligned morally, but we are not sacrificing performance. And if anything, if you look at the risk return profile of this fund, it's actually more attractive, arguably, than some of the things that you're probably investing in now.
Yeah, attractive from a financial and a theological perspective.
Yes.
I think it's huge. And, as we build AUM, right, if FTHB reaches $1 billion, right, what does this look like in terms of, collaboration, kingdom impact, kind of that flywheel effect as we've mentioned before on, some of our speakings?
Oh gosh. When FTHB hits $1 billion, it's going to be huge. We'll be able to take the proceeds from that management fee and effectively allocate millions of dollars, not just to these donor advised funds for Christian higher education, but also to reinvest in the flywheel, to reinvest to the marketing department, into the finance classes, bringing employees on board to further invest in the university, effectively just like exponentially compounding the impact as that fund grows. That's, I think, what's the most exciting is, right now it's a very, very interesting project and a worthwhile project. And as this thing grows and has legs, it's going to have a real impact, a real economic impact and investment impact into the Christian ecosystem across the country.
Yeah. Kind of in that Christian ecosystem too, looking at young investors coming into the markets, looking at, how the world's changing, how investing is changing, how now we have, Kalshi and Polymarket and predictive markets are starting to grow. What can, young investors be preparing themselves for? What can we, be focusing on, and what can we be, looking forward to in a world that's going to be changing pretty soon?
Wow. That's another good one.
A lot to unpack there.
I think one of the cool things about FTHB and the partnership with Grand Canyon is that it's a really healthy pushback against the gamification of investing. The last 5-10 years, this gamification, right? I mean, there are, to Robinhood's credit and Kalshi's credit, right? They've really expanded the network of investors, potential investors, if you want to call them that. There's a lot of people that use it for very, very speculative. I would call it gambling. Nonetheless, it's kind of democratized access, so that's a good thing. But the thing that I think the negative to those platforms that are very popular with the youth is that it's not real investing. And I'm confident in saying that, right? That a lot of these people aren't actually looking at the fundamentals of what they're investing in. They're looking at videos on TikTok or wherever, and they're doing kind of backhanded momentum analysis to try to, that's something I think that FTHB is going to do a great job for, at least the students here at Grand Canyon, is give them a very sobering view of what investing is. Understanding the credits, the actual credit risk of these businesses, of these lending platforms, understanding the financials, appreciating market momentum, but understanding that it's just one small variable in the context of what moves markets. Giving them that kind of healthy, sobering perspective, I think, is going to add a lot of value, honestly, for this generation of investors, particularly guys and girls who are trying to become professionals on the other side of graduation.
Yeah. I think, wrapping up here, I want to thank you for your time coming in today. I think there's so much there, and I think that there's a lot happening in the investing world, a lot happening at Grand Canyon University, and, a lot happening with the collaboration that people are starting to become, more aligned with how they actually view their investments making an impact versus just the return that they're getting. So I think wrapping up here, I want to just ask you one more question on if you could leave one message to, the next generation, or one message for, just people out there in the world, what would it be coming from Joe Hegener?
Oh gosh. If I could give one message. I could give one message to aspiring graduates, students, it would be to be true to yourself. Really, really understand what it is that makes you tick as a person, and do your best to really, really understand. That's, I think, in my opinion, how you're going to get over some of your personal vulnerabilities and make you a smarter, more well-rounded, well-adjusted person, is to kind of look internally and really don't pull any punches, right? Just kind of be honest with yourself and be unapologetically yourself as well. And this, especially in this world where increasingly social dynamics are online, there's a lot of people and young people that are comparing themselves to others. Just to be really, really true to yourself and unapologetically yourself, and the world is your oyster. People are going to love that. If you're a genuine person, that brights up the whole room. And I think if you just continue to pursue that, good things are going to happen.
Very impactful, Joe. Thank you.
Yeah, my pleasure.
Yeah. Well, thank you so much for joining us today. For any more information, you feel free to, keep following us and keep on track with everything we have going on. Again, the ticker symbol for today is FTHB, but we appreciate your guys' time and hope to see you next time. Thank you.